Today we're going to be looking at if the Santa Claus Rally is for real. And I have to say, why yes, Virginia, there is a Santa Claus, and his rally is real enough. Ho, 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 or in this case, I should say do, do, do. We're going to dig in the details of Santa Claus Rally, but before we do, I'd invite you to make comments or suggestions for future videos down below. Also, if you like this video, please remember to subscribe and hit that like button for me. So, the Santa Claus Rally is the tendency of the stock market to go up during the 5 trading days after Christmas and then continue to go up for the first 2 trading days of the new year. If we look at 2021, Christmas this year in the stock markets at least is going to be observed on Christmas Eve, December 24th. So that will give us a full week of trading heading into the new year between December 27th and the 31st. And then the 2 days after New Year's will actually be January 3rd and 4th to start 2022. Which, wow, 2022 seems so much has gone on in obviously 2020, 2021. COVID, stock markets rally, we're up, we're down, everything. It seems amazing that we're saying 2022 now and getting there. Hopefully it's going to be a good year for all of us and things will be moving forward. So is the Santa thing for real? If we look back, it was first described by Yale Hirsch, who was a market analyst at Stock Traders Almanac, and he did this way back in 1973. And he went back and did some data sets and looked at things before and analyzed and found this sort of anomaly or phenomena where there were unusual positive returns, which he attributed to being the Santa Claus Rally during this holiday period. If we look at the 70 years between 1950 and last year, 2020, in these 70 years, there's been 57 Santa Claus rallies. So that's happening a good amount of time you will get a Santa Claus rally. Obviously, there's a few years where it didn't happen, but for the most part, we get one. And it's been pretty meaningful. So the S&P 500 has gone up an average of 1.3% during these rallies. And in the 2008 rally, we had our biggest one ever, and the S&P 500 went up by over 7% in just 7 days of trading. So that's a pretty good run. So why do we think this happens? Some people might say, who cares? I'm just going to invest off it. But if we take some time to think about this, there's a number of reasons, and we can dig into all of them and see if they make sense and if it's something that we truly believe in and can profit from. So the first one is just that it's the holiday season, and people are generally feeling more optimistic. They're spending time with family. They're getting presents. They're going to parties. We end the year, and often there's a calendar year effect psychologically for us. We just feel better going into the next year, and this is thought to translate into higher stock prices. December overall is generally a positive month, as there's a combination of normal month-end effects, and also, like I said, you're rolling into a new year and people start putting money to work. And this increases a bid for the stocks, which is always good for prices when you have incremental bids coming in, but it's also during a period where a lot of professional traders and portfolio managers are taking time off to be with their families. So trading volumes between Christmas and New Year and the first couple of days of the New Year are lower than they are at normal times. So this sort of pressure on the margin, moving the prices, has more of an effect during this week of traditionally low volumes than it would, say, on a random Wednesday in February, which is something people like to say about, say, meaningless basketball games in the NBA or just some other time. If you think about a normal day, the time between Christmas and New Year's isn't normal. People aren't paying as much attention to the market. They're at home. They're out of the office. You're not looking at screens. You're not managing your teams. It's sort of a lull. You've got a skeleton crew in there, and because of that, trading volumes are lower. So the next point is one that I can't always get behind, but I'll go through it anyway. And it's something that's referred to as window dressing. And this isn't the kind where you're putting decorations up around your window. This is the idea that portfolio managers and people managing other people's money who've missed out on the hottest stocks during the year will add them to their portfolios before year end, so that when they're describing what's in there, either in an investor's letter or talking to people, they can at least say that they own the stock. Now, they may have missed, 11 months of exceptional returns from a stock, but they can say, hey, yeah, I own this. And if we look through this year, obviously some of the meme stocks had spikes and things, but that was really volatile. But some people may be putting names like Nvidia, Ford, Moderna. If you go through a list of the kind of top stocks for the year, the things that have moved the most, there's an idea that some people may be entering into those for what's called window dressing, and you could get a little bit more of an uptick on those particular names. So you could look at them particularly. Now, as I said, I'm sort of skeptical that how much this affects pricing, but I used to be a hedge fund auditor with PricewaterhouseCoopers in the 1990s, and when I was auditing hedge funds, it was one of the things that we actually looked for, and it's still thought to exist. And if you think that there might be some window dressing, you can go and look, like I said, for names that have outperformed during the year and think some of the people who've missed them may want to buy them now, and that'll give them a little bit more outperformance just to end the year. So we also have something which I really believe in, which is that the tax loss selling is done. So a lot of investors will sell losing stocks so they can take the advantage of the tax loss. When this takes place is towards the end of the year, and it's pretty much done by Christmas time. Some people do it towards the end of November, early parts of December, but it's pretty much done. So this takes some of the pressure off those stocks that have underperformed, and it makes it easier for these stocks to rise. The flip side of this is also that some people in those first couple of days in January are going to be buying these tax loss stocks back, or entering in stocks that they think, okay, these were beaten up. Some people sold them for tax reasons, and I think maybe their prospects are better, so they're going to buy them in January. Now, there's something also called the January effect, or the small firm in January effect, and we'll deal with that in another video. But you do have this upward pressure on certain stocks during the first couple of trading days in January. The biggest one, I think, for retail investors and why they're going in is what you'd refer to as a new money effect. So an analogy would be just like people buy gym memberships or they get a gym membership for Christmas. The start of a new calendar year or the end of the year is when people think, hey, I'm going to get in shape. They also think we're going to get our finances in shape. So you also combine this with many people receive year-end or Christmas bonuses, or they may even just be figuring out how much extra cash they have at the end of the year, and then they could be putting that money to work in the stock market. And this definitely, from the research I've seen and intuitively makes sense to me that other people are getting in and they're buying stocks during this period. And again, it's during a level where institutional volume is lower, so it sort of pushes things up a little bit during there. And the last reason, which is probably the most overriding one, is it's an observable pattern over a 70-year period at this time. Now, we'll have the 71st year here in 2021, but if we look at the percentages, we said earlier, 57 out of 70 times there has been a meaningful Santa Claus rally during these trading days between Christmas and the first couple of days after New Year's. If you do a percentage on that, it's 81.4% of the time. That's an overwhelming period where most likely you're going to get a little bit of extra performance, and you can adjust your timing and take advantage of that. So if people think stocks are going to go up during this period, then they're going to act like stocks are going up during this period. And those actions actually cause the stocks to go up during this period, which is why we say it's a self-fulfilling phenomenon. So we could look at this and we can probably think of a few more reasons why stocks may be going up during the Santa Claus rally period. And I do know that there's people out there who will say there's no such thing as a Santa Claus rally. But I think the overwhelming fact that you've had over 80% of the years over the last 70, which is longer than most people alive right now have been investing, we've had rallies. It shows you that it is a real phenomenon, and it's something that may very well be repeated in 2021. So we could end the video right now, but probably some of you are thinking, okay, that's great, Richard, but what does this mean for me, and why do I need to care about this? Is there any way that I can profit from it? So we'll take a step back and we'll think about market timing. And usually we'll make the argument that you shouldn't be trying to time the market unless you're seeing a specific catalyst that's causing you to enter, and you really have a lot of conviction on it. But getting in and out, is one of those things. If you're going to trade, that's different than investing, and that's subject, probably for other videos, books, and courses and things. But if you know that 80% of the time you're going to get a rally and it could affect it by a meaningful amount, then you should be adjusting your timing. So if you're looking at this, rather than waiting till January to put your money to work, why don't you pull that forward before Christmas? So you put it in there and then you get the little run up, right? So if you've had your eye on a blue chip dividend stock or a growth stock that you've done some research on, or something just that you've been following and you were thinking, you're going to purchase this, most likely it will be a better idea to be purchasing it on the 22nd, 23rd of December than waiting for the first couple of days of January, because most likely it's going to be more expensive once you hit that January period. So is there anything else on that? Well, if you're sort of at a higher level of investing and you're doing some options trading, or perhaps you're using covered calls to add income to your portfolio, if you think about your call writing, then you should wait, because you'll be writing the call on a stock that most likely is at a higher value if you're waiting into the January period, because you should have had that run up, which on average we said is 1.3%, but in a big year, this could be 5, 6, even 7% like it was in 2008. On the flip side of the options, if you're buying puts to hedge your portfolio, it's going to be better to wait. It'll just be more effective for you. But we'll be talking about this in some other videos when we get into options. You're probably better off writing options than buying them most of the time, but there are specific reasons why you might be wanting to buy a put. Please let me know what you think of this video in the comments below, and remember to click, tap, or smash that like button and subscribe to the channel. Also remember, finance isn't as easy as 1, 2, 3, but with a little work, it can become as simple as 3, 4, 5.